Hey everyone, Scott here, and this week we're going to talk about market volatility a little bit more. And specifically, we're going to show you how adding some safety can be incredibly important to your retirement. A lot of times we'll see someone come in and maybe they have $1 million saved for retirement, and the way they've gotten there, maybe they're still working, the way they've gotten there is by being aggressive, right? They've just kept it real simple. Maybe inside their 401k plan, they just invested in an S&P 500 index. And while that was a perfectly fine strategy for an aggressive investor during those growth phases of their life, once you hit retirement, we got to be a little bit more careful, a little bit more selective, and we're going to show you why. Now, the last 10, 12, 13 years even, it's hard to remember that the market does not always go up, right? So this screen right here, this chart that I'm showing you, that green line that's just nice and steady, right? It's just right there at about 10%. That's the average return since 1996. In reality, what the investor felt each year is this yellow line. So here's 20%, 30%. 2000 was way down here. It was negative. Here's 2008. It was negative. So that's volatility. On a year-to-year basis, the market does not get you a straight 10%. So another chart that I think does a good job of showing volatility. So let's assume we can go back in time and you have $1 million and you're ready to retire. And let's assume that you're going to take 4% off of your portfolio. That's a common strategy, the 4% rule. So you got $1 million, you're going to pull 40 grand a year in year one. And then if the market goes up, you're going to get to take a little bit more. If it goes down, you got to take a little bit less. But either way, it's 4% every year. And this chart right here, this is assuming that you are invested 100% in the S&P 500, okay? Just a nice, simple way. Now, don't get me wrong, we're not predicting that this is what's going to happen over the next 20 years. This is just showing what would have happened if you retired in the year 2000. So you started with $1 million, and as we saw on the chart above, market dropped. So immediately you're falling down. Remember, you're still pulling 4% a year out. Now you start to make some headway in the mid 2000s, and then boom, the great financial crisis hits, and your $1 million retirement nest egg, 9 years into hopefully a 30, 40-year retirement, is down to $412,000. Now this is important for a couple of reasons. First off, are you going to be able to stomach watching that $1 million drop to 412? Because remember, the only way that this could possibly be salvaged is by not selling when that $1 million portfolio has dropped to 412. So that investor that says you should just keep an S&P 500 index fund and nothing else, okay, that's fine. But this investor has to be able to hang on, has to be disciplined enough to watch their portfolio drop all the way down to 412,000, stick with it, and then let it come back up like it has the last 12, 13 years. Now, let's show, the other important aspect is that 4% of 412,000 is a whole lot less than 4% of $1 million. So your portfolio income using that 4% rule just went from 40,000 a year down to 16,000 a year. So not only have you watched your portfolio drop, but your lifestyle, your income has gone down a significant amount as well. So now let's show you what it looks like if we add some safety. So if we go from 100% growth, 0% safe, let's just go 50-50 for simplicity. Now it shows 2009 when it got down to its bottom. You went from $1 million, still dropped. The 2000s were a rough time for investors. You still went from $1 million and you dropped down to 794,000. Now, don't get me wrong, it's not fun. That wasn't a good 8, 9, 10 years, but your portfolio is still intact and your income really hasn't dropped all that much. At 800,000, that's about 30,000 a year in income. So yeah, you went down a little bit, but nowhere close to what you had if you had 100% safe. Now, of course, I could show you what does it look like if you were 100% safe during those years, but I don't think that's really going to be fair because we are just cherry picking a rough 10-year period, kind of this worst case scenario, retiring in the year 2000. But the thing is, we don't know where we're at. We don't know, are we right in the middle of a long, sustained bull market in the stock market, or are we at the peak right now? We don't know. And that's why we want to invest in a way to combat market volatility without having all of that information. If we had perfect information, everybody would know exactly how to invest, but we don't. And so that's why we have to construct your financial house with some safety, as well as be able to take some risk in case we have what happened the last 10, 12 years where the market had a sustained bull run. So I hope that this showed you kind of the benefits of adding some safety into a retirement portfolio and why it doesn't just have an impact on your bottom line number. It has an impact on your income in retirement as well, depending on how you set up your financial plan. So if this helped you at all, give us a call, 844-CARLSON. If you have not talked to an advisor, if you have not got your investment plan put in place, give us a call, set a time to come see an advisor, or go check us out at carlsonfinancial.com, Carl's Corner. You can see past videos where we go into a little bit of depth on different retirement planning topics. Hope to see you in a few weeks. And with that, have a great rest of your day.